Your savings are being silently stolen. And it's not by thieves, it's by central banks. Quantitative easing creates new bank reserves and injects massive amounts of money into financial markets, pushing up prices while keeping interest rates near zero. As a result, your cash loses value every single day. After 2008, for example, the Federal Reserve's balance sheet jumped from $900 billion to $4.5 trillion, and stock markets surged. This policy favors those holding assets over cash savers. Most people don't realize how these policies quietly erode their wealth. To understand the real impact, you need to see what's happening to your savings in this environment. This is the silent theft at work. Your savings account earns a fraction of a percent in interest, while inflation steadily erodes the real value of your money. Even if your bank pays 0.5% interest and inflation runs at 2 to 3%, in line with the Federal Reserve's stated target, you're still losing purchasing power every year. Traditional advice says to keep your emergency fund in a savings account, but in today's environment, that strategy almost guarantees a slow loss of wealth. The financial landscape has shifted, yet most people haven't adapted. Let's look at the numbers. If you put $10,000 in a savings account earning 0.5% interest, you'll have $10,050 after a year. But with even modest inflation at 2 to 3%, you'd need $10,200 to $10,300 just to maintain your original purchasing power. That means you're falling behind by $150 to $250 in real terms. And this gap widens each year as the effect compounds. Your so-called safe money becomes less valuable over time, while the cost of everything from groceries to housing keeps rising. With a Fed target of 2%, savers lose purchasing power each year by design. This isn't a bug in the system, it's a feature. Over the past several decades, Federal Reserve data shows that the dollar's purchasing power has steadily declined. The process is gradual, making it easy to ignore in the short term, but impossible to miss when you look at the long-term trend. The impact isn't felt equally. Younger workers might see their wages rise with inflation, but their savings rarely keep pace. Middle-aged savers watch as their carefully built nest eggs shrink in real terms. Retirees on fixed incomes face the harshest reality. Their purchasing power drops every year, while their savings generate little interest. Conservative investments offer little protection. Treasury bonds with 2 to 3% yields barely match inflation, and money market funds or CDs often lag behind. Even the classic 60-40 stock bond portfolio has struggled to deliver positive real returns in recent high inflation periods. Financial institutions still promote these traditional approaches, but the environment has changed, and so have the rules. The root of this problem is monetary policy. When central banks expand the money supply, more dollars chase the same goods and services, pushing prices higher. Your bank may pay you interest, but not enough to offset the real loss. Meanwhile, banks lend out your deposits at higher rates and profit from the difference, as your savings lose value. This creates a system where prudent savers are penalized, while borrowers benefit from paying back loans with less valuable dollars. The incentives have flipped. Saving in cash is punished, and taking on debt is rewarded. To understand why this happens, you need to look at how central bank actions, especially when they buy bonds, reshape the entire financial landscape. Let's break down how the Fed's money printer actually works. When the Federal Reserve wants to influence the economy, it creates new bank reserves electronically and uses them to buy long-term government bonds from banks. This isn't a simple transfer. These reserves didn't exist before. By adding to the bank's reserves, the Fed injects liquidity directly into the financial system and pushes bond yields down. Once the Fed buys these bonds, it removes them from the market. The immediate effect is to increase demand for government debt, driving up bond prices and pushing yields lower. Banks, now holding more reserves, look for ways to earn higher returns. With government bonds paying less, they're encouraged to lend more or invest in other assets. This is how quantitative easing sets off a chain reaction throughout the financial markets. The scale is hard to ignore. After the 2008 crisis, the Fed's balance sheet expanded from $900 billion to $4.5 trillion. In 2020, it nearly doubled again, reaching close to $9 trillion. These weren't just accounting entries. Each round of asset purchases added new money to the system, fueling asset price increases and keeping yields near historic lows. Mortgage rates tumbled, making home loans cheaper, but home prices soared. Stock markets hit record highs as investors chased returns. Meanwhile, savers saw deposit rates stuck near zero. This process doesn't just affect interest rates. Normally, bond markets provide signals about economic risk through the yield curve. When the Fed buys up long-term bonds, those signals are distorted. Investors searching for yield move into riskier assets, stocks, real estate, even speculative investments, because safe government bonds offer little return. Studies find QE forced investors into these riskier assets when government bond yields fell to near zero, a dynamic known as the portfolio rebalancing channel. This shift inflates asset prices and can create bubbles that wouldn't form under normal market conditions. Every major asset class reacts to these interventions. Companies borrow cheaply to buy back their own shares, pushing up stock prices. Real estate becomes more attractive as mortgage rates drop. Even gold can rise, not because it pays interest, but because investors worry about currency debasement. The Fed's stated goal is to create a wealth effect. As asset prices rise, people feel richer and spend more. But this effect is uneven. Those who already own assets benefit the most, while people without significant investments face rising costs and stagnant wages. This is a documented monetary policy with clear distributional effects. The mechanics of quantitative easing don't just change interest rates, they reshape who benefits and who falls behind. The next step is to look at what the data reveals about this shift and how monetary policy has become a tool for wealth redistribution. What's happening is often called the Great Wealth Transfer. Quantitative easing doesn't just stimulate the economy, it shifts who holds wealth and who gets left behind. Central bank research, including from the Bank of England, shows that the main winners are those who already own financial assets. Older households, who typically have more stocks and bonds, saw the biggest gains as asset prices climbed. This isn't a theoretical claim. The Bank of England found QE increased aggregate household wealth by 26%, with most of those gains flowing to the wealthiest 5%. Generational divides are clear in the housing market. After 2008, aggressive monetary policy pushed home prices up much faster than wages. Younger buyers now face a landscape where property is far less affordable than it was for previous generations. Those who already owned homes before these policies saw their net worth surge, while first-time buyers struggle to get a foothold. The intended economic stimulus has, in practice, created a barrier to wealth accumulation for many. The concentration of gains is stark. According to central bank studies, the wealthiest decile holds nearly 9/10 of all stocks and mutual funds. When QE inflates asset prices, this group captures almost all the upside. While there are some broader benefits, like job creation and higher spending, the direct wealth effects are highly uneven. Central bank data confirms that the bottom quarter of households saw little improvement, while the top 5% experienced significant portfolio growth. Corporate behavior changed as well. Cheap borrowing costs fueled a wave of share buybacks, which in turn pushed stock indices higher after 2008. This cycle further amplified gains for those with existing investments, while doing little for those without meaningful exposure to financial markets. Traditional retirement strategies haven't kept up. Retirees who shift into bonds for safety now face negative real returns, as QE has driven yields to historic lows. Younger savers encounter a double challenge: stagnant wages and asset prices out of reach. The structure of the system moves purchasing power from cash holders and savers toward borrowers and asset owners. Across all major asset classes, the pattern repeats. Real estate, stocks, commodities, and even cryptocurrencies have all benefited from the search for returns in a low-yield world. But access to these gains depends on already having assets or the ability to borrow. Most people holding cash or relying on fixed incomes see their wealth erode. This pattern isn't random. The flow of new money begins in financial markets and with institutions, not households. By the time the effects reach wages and consumer prices, the primary beneficiaries are already positioned. The system's design ensures that asset inflation comes first and broad-based benefits come later. if at all. Understanding this transfer is key to seeing why the system works the way it does. The structure of monetary policy is not just about economic stimulus. It's about managing deeper fiscal realities. Governments face a problem that rarely gets discussed openly: the challenge of managing massive debt without triggering public backlash. Inflation becomes the subtle tool of choice. When a government owes $100, that amount stays the same in nominal terms, but as inflation rises, the real value of that debt quietly shrinks. This process acts as a silent tax on creditors and savers. For governments, it's a politically palatable way to reduce the debt burden without raising taxes or cutting spending. IMF economists note that many high-debt countries rely on steady inflation to lower real debt ratios over time. History is full of examples where inflation was used as a deliberate strategy to deal with unmanageable debt. After World War I, the Weimar Republic in Germany faced impossible reparation payments and domestic debts. The government responded by printing money at an unprecedented scale. Within a few years, hyperinflation wiped out both public and private debts, but it also destroyed the savings of ordinary citizens and collapsed the economy. In more recent times, Venezuela's annual inflation topped 1.7 million % in 2018, erasing debt in real terms, but leaving the population with worthless currency and devastated purchasing power. These cases show that, when debts become overwhelming, governments often turn to inflation as the path of least resistance. In today's world, the process is more subtle. Quantitative easing, central banks buying government bonds with newly created reserves, acts as a modern form of debt monetization. The Federal Reserve's balance sheet grew from $900 billion to nearly $9 trillion between 2008 and 2020. This expansion supported government spending and kept borrowing costs low, but it also increased the money supply and contributed to rising asset prices. The European Central Bank acknowledges the risks. Easy money policies can inflate bubbles in property and financial markets, and the side effects can threaten financial stability. Why not just raise taxes or cut spending? These options are politically costly. Defaulting on debt destroys a government's credibility. Inflation, by contrast, erodes debt quietly and gradually. If inflation runs at 5% while bond yields stay at 3%, governments effectively pay negative real interest rates. This makes borrowing attractive and helps manage budget pressures, especially with national debts at record highs. The incentives are clear. Governments borrow more, knowing inflation will help reduce the real value of what they owe. Creditors, anticipating this, demand higher rates, which can push central banks to intervene even more. Over time, this cycle can become self-reinforcing, especially if confidence in the currency starts to slip. The warning signs emerge when debt monetization accelerates or when official inflation statistics become less transparent. Understanding why governments need inflation puts today's policies in perspective. It's not just about economic stimulus, it's about managing the risks that come with high debt. But there's a fine line between controlled inflation and something more dangerous. The next step is knowing how to recognize when that line is about to be crossed. Hyperinflation is not just an extension of high inflation. It's a complete breakdown in the value of money. Economists define hyperinflation as price increases exceeding 50% per month. This threshold is not theoretical. It has been surpassed many times in history, often with devastating results. Hungary's 1946 episode stands out as the most extreme on record, with prices rising by 207% per day at the peak. Zimbabwe's crisis offers another example. Economist Steve Hanke estimates the annual inflation rate reached 89 sextillion% in November 2008. In those conditions, a $100 trillion bill could not buy a bus fare. What drives such rapid currency collapse? The pattern is consistent. Governments facing severe fiscal pressures resort to printing money to finance spending. When this expansion of the money supply is not backed by real economic growth, the currency begins to lose value at an accelerating pace. In Weimar Germany, after World War I and under the weight of reparation payments, the government printed money to cover its obligations. In 1 year, prices soared by a factor of 250,000, and Germans used wheelbarrows of cash to buy daily essentials like bread. In Yugoslavia during the early 1990s, hyperinflation lasted 22 months. peaking at a monthly rate of 313 million%. The effects are immediate and severe. As people lose confidence in the currency, they rush to spend money before it loses more value, which only accelerates the price spiral. Goods are hoarded, shelves empty, and shortages become widespread. Savings quickly become worthless, and even basic transactions become difficult. Governments may respond by issuing ever larger banknotes. Hungary's 100 quintillion pengo, Zimbabwe's $100 trillion bill. But these measures do nothing to restore trust. In Venezuela, redenomination and the introduction of new bills failed to halt inflation, and the currency continued to lose value. The psychological component is crucial. Once people expect prices to rise uncontrollably, they abandon the currency in favor of anything that might hold value: foreign money, goods, or hard assets. This loss of faith can turn a bad situation into a full-blown crisis in a matter of months. While modern economies have more safeguards, the underlying risks remain. The same forces, rapid money supply growth and unchecked government spending, can set the stage for instability. The most important red flags are government-backed debt monetization and the disappearance of reliable official inflation data. Recognizing these signals early gives you the chance to adapt before the system changes around you. Protecting your wealth in an environment of persistent inflation requires a shift in strategy. Instead of relying on traditional savings accounts or fixed income assets that lag behind rising prices, large investors and institutions focus on assets that either maintain purchasing power or stand to benefit from the currency debasement. The familiar 60-40 stock-bond portfolio often underperforms when bond yields trail inflation. The solution is to build a portfolio that can withstand the pressures of ongoing monetary expansion. Commodities have a long track record as an inflation hedge. Precious metals like gold have served as a store of value for centuries because their supply increases slowly. During the 1970s, when inflation surged above 10%, commodities outperformed stocks by an average of 8% annually. Gold moved from $35 to $850 an ounce in that decade, and other metals like silver and platinum also preserved wealth, although with more volatility. Industrial commodities, oil, copper, and agricultural goods often rise in price as production costs climb and demand stays steady. These assets cannot be created at will by central banks, which gives them unique protection against currency erosion. Real estate is another proven buffer. Property values typically keep pace with inflation as replacement costs and rents rise. Unlike cash, real estate offers the added benefit of leverage. Fixed-rate mortgages allow you to repay loans with money that becomes less valuable over time, while the underlying asset appreciates. Exposure to real estate can be obtained directly or through real estate investment trusts, or REITs, which offer diversification without the need for direct ownership. Treasury inflation, protected securities, or TIPS are specifically designed to safeguard against inflation. The principle of TIPS adjusts with the Consumer Price Index every 6 months, so your investment's real value is preserved even as prices rise. While the yields may appear modest, the automatic inflation adjustment provides insurance for purchasing power. TIPS are widely used by institutions for capital preservation, and their government backing adds an extra layer of security. Certain equities also offer resilience. Companies with strong pricing power, such as those in the energy or infrastructure sectors, can pass rising costs on to consumers. Businesses with revenue streams linked to inflation indexes or essential goods tend to maintain margins even as input prices climb. Blue-chip stocks with reliable cash flows have historically performed better than speculative growth stocks during inflationary periods. For more precise hedging, investors can use inflation swaps or specialized ETFs. These instruments use derivatives to track inflation indexes and are available through mutual funds and ETFs. While more complex, they allow for targeted protection and are commonly used by institutions to balance inflation risk. The effectiveness of these strategies depends on allocation. Institutions typically blend commodities, TIPS, real estate, and select equities to avoid the guaranteed loss that comes from holding cash. Even a small shift, moving 5 to 10% of cash into inflation-protected assets, can make a measurable difference over time. The aim is not to predict inflation perfectly, but to build a portfolio that is resilient to the forces shaping the financial system. A consistent historical pattern emerges. During periods of monetary expansion and rising prices, tangible assets and inflation-linked securities best preserve real wealth. Adjusting your approach to reflect this reality is a practical response to the incentives built into the current system. When inflation becomes part of the system, your response should be deliberate. As we saw, even modest allocation to inflation-linked assets protected portfolios in past QE cycles. Shifting just 10% of your cash into assets like tips, gold ETFs, or real estate can help preserve purchasing power while the broader system continues to erode the value of savings. A practical first step: review a tips fund's prospectus or check the price of a popular gold ETF. Compare these with your current holdings to see which option fits your risk profile. Taking action, even on a small scale, can have a meaningful impact over time. QE-driven inflation is here to stay. Choosing assets that reflect this reality is how you outsmart the system today.